individual savings accounts, or ISAs. This video is all about ISAs, the three sorts of ISAs: the normal one, the lifetime ISA, and a child ISA. What I'll be going through is what you can put into the ISA, why you might want to put money into an ISA and what the benefits are, and then what the rules and limits are. This is part of a series of videos about tax and accounting issues, so if you'd like to see further videos, then please subscribe to the channel, and if you press the like button, it helps me get the message across. So ISA, what is an ISA? Well, they call it a wrapper. So what you do is you allocate an amount of money that you lodge with an institution, and that is registered as your ISA. And the benefit of it is that that money then becomes like a tax-free fund. So there's no capital gains tax if you sell investments, and there's no income tax on the income from the investments. Now the limit is £20,000 each year, but it's for each of a couple. So for me and my wife, we both get £20,000 a year, and I'm filming this in January, so I get £20,000 for this tax year, and then as soon as we get it onto the 6th of April, we'll get another £20,000 each. So if I wanted to invest £80,000, we could do that through an ISA by the 6th of April. So you can get reasonably large amounts of money into an ISA reasonably quickly. Now the tax benefits, if we think about the tax benefits, you don't pay income tax and you don't pay capital gains tax. Well, you have to have a reasonably large portfolio of investments to pay capital gains tax, because you get over £12,000 of tax-free gains each year. So you've got to go over that before you start paying the tax. So for most people with modest amounts, that's not too much of a worry. But if you've got substantial amounts, you want to use the ISA so that you can avoid capital gains tax, and it avoids the dividend tax or income tax on investment income. Well, for most people, you don't pay dividend tax on the first £2,000 of dividends anyway. So you've got to have a reasonable size portfolio to get more than £2,000 of dividend income. But if you've got your own company, so you're paying yourself through dividends, you're already using up that allowance. And if you're a high rate taxpayer, the dividend tax is at 32.5%, so it kicks in quite hard. So for people like that, then it is more important to use your ISA allowance. And what I'd say is that just as over the next few months, I could put in £80,000. If you put in £20,000 every year, of course, you're building up quite a substantial fortune in your ISA, and that remains tax exempt. So it is something where you can accumulate funds and you can accumulate a tax exempt fund. And I think that's the best way to think about an ISA, as well as to use the allowances in each year so that you are building that fund within your ISA. So that's all I want to say about the main ISAs. I'll move on to the Millennials ISA, or the Lifetime ISA. So this is so you can start it when you're between the ages of 18 and 40. And once you're over 40, you can still put into it, if you already set one up, until you're 50. And then you've got to stop putting money into it. Now the Lifetime ISA is better. So the amount you can put in is less. So you can put in up to £4,000 a year, but not only is it tax-free on the income, but also the government tops it up with 25%. So if you put in £4,000, the government tops that up to £5,000. It's a bit like a pension scheme, and that was what it was sort of intended to do. You can put this money into your Lifetime ISA, and you can use it, well, if you've got a terminal illness, but let's hope not. But mostly you can use it to buy your first house, or when you reach the age of 60, you simply get the money and you've got that tax refund, if you like to call it that, and it just crystallizes and you simply keep the money if you reach the age of 60 and when you reach the age of 60. If you take the money out early, obviously you lose the benefit of the money that the government's put in. Now, although you might think that that's really for 18 to 40-year-olds, maybe 50-year-olds, it can also benefit people of my age as well. Because if you've got young adult children or young adult grandchildren, it can be, and particularly if you're sort of hoping or expecting to pay for the deposit on their first house, it's a really good way of the government paying for a quarter of the deposit on their first house. So you can put £4,000 in, you can gift it to them, put it into their lifetime ISA, and then they can build up a fund to use as their deposit on their first house. So it can be really useful for all ages, not just for millennials. There is also a child ISA, and I've tried to think who this is aimed at because I can't really work it out, but you can put £9,000 a year into a child ISA on the child's behalf, but the tax savings are dividend tax, income tax and capital gains tax. Well, I just don't know any children that pay capital gains tax, income tax or dividend tax. I don't know, maybe they do exist. I mean, for the main tax saving as a high rate taxpayer, then the child has to have an income, presumably an investment income of over £50,000 a year. Well, no children that I come across have income of £50,000 a year. I don't know who this is designed for. It must be a tiny, tiny number of people. I guess what it could be useful for is if you're a grandparent or a parent and you want to build up a fund for the child, so if you put £9,000 a year in for 18 years, it's a lot of money to give it to a child. Good luck to them, because when they get to 18 they'll have access to it, and you can feel brave about that if you like, but they get that money and then it will still be in a tax wrapper, so I suppose that will be of advantage. But it's just out with my experience of real life, so it's a peculiar one. But anyway, I think the lifetime ISA is really useful for both older people to give to younger people and for the younger people. And the general ISA is really good, particularly if you're building up a portfolio within it. As I say, this is part of a series of videos about tax and accounting issues. So please call me if you want to discuss the issues, subscribe if you want to be kept in touch, and then, as I say, this is part of a series of videos about tax and accounting issues. If you would like to subscribe, you'll be very welcome to join us and you'll be kept up to date with matters as they arise. Please ring me or call or put a comment in the notes if you've got a question or some thoughts on the video. And if you like press the like button, it helps me get that message across.